The following content is meant purely for educational and informational purposes and should not be relied upon as financial, investment, legal, tax, or any other professional advice. This is the Fundamentals Podcast, where we demystify crypto and help you navigate this ever-evolving internet-native economy. In this episode of the Fundamentals Podcast, we're joined by James and Vincent, the co-founders of Modular Capital, a crypto investment firm with a fundamental and thesis-driven approach. Over the next hour, we discuss Modular Capital, their investment strategy, underwriting process, and how they work with the projects they invest in. We discuss what makes crypto interesting and what the most common misconceptions are that traditional investors have about the asset class. We speak about the pros and cons of liquid venture, the role that data has in Modular's investment process, and we walk through some case examples of investments Modular has made. Finally, we discuss what developments James and Vincent are most excited about in crypto right now. Tune in for a great discussion about the fundamentals of this asset class. I was just checking out our dashboard on bridge deposits to base, and that's an impressive curve at the moment. Just like up only, the amount of assets being bridged to base right now is pretty impressive. And I'm feeling quite bullish on Coinbase. I don't know, have you guys had the chance to bridge to base or play around over there yet?
Yeah, we have. I've played around with like the Coinbase wallet experience. I think it's pretty spectacular just in terms of the UI, how friendly it is. I think you have bridging natively integrated in it to Base, Polygon, Optimism. The experience is pretty smooth. I think Friends Tech started getting a good amount of traction as well. We'll see how sustainable it is, but that's been a pretty common use case on the bridging side. And then I think from an ecosystem launch perspective, it's probably one of the strongest that we've seen from day one. You have a lot of the top DeFi apps there out of the gate, Uniswap, Compound. I think Aave just launched today. Sushi is there, Balancer is there. I think Synthetics will pass a proposal pretty shortly to deploy there as well. So just the quality of the applications that prioritized Base from day one, I think is incredibly impressive. And that whole Coinbase machine and kind of ecosystem, kind of business development capability, I think you've really seen that with this launch.
Yeah, and I love that the on-chain narrative is now being pushed so heavily by a giant player like Coinbase. That just has to be great for adoption.
I think one of the big differences between now and 2 years ago is if you think about where we were in 2021, these rollups didn't really exist yet. I think people were doing on-chain things on ETH mainnet. Both Vincent and I have paid $100, $150, $200 gas transactions out of our wallet to go do a Uniswap transaction. And then I think back then, I think Solana also just had infrastructure issues that they had to work through. They were having outages pretty frequently every few months. Since then, they've rolled out things like kind of localized fee markets. They've kind of upgraded some things on the infrastructure side. So I think just generally the infrastructure to do on-chain activity has matured a lot. We've come a pretty long way since 2 years ago. And I think all that, whether you're in the Ethereum ecosystem, whether you're in the Solana ecosystem, it sets it up a lot better for kind of users to find their way onto these chains. And then you have account abstraction getting rolled out as well. So people are trying to find more and more ways for users to transact, not have to go explicitly pay a gas fee. I think that's something that a lot of these rollups are prioritizing. So just a lot of things like to make it easier for users to transact, be on chain, not have to worry about a lot of kind of backend security type things. So it's pretty exciting to see.
Exactly. I mean, I couldn't agree more. They're definitely feeling the momentum pick up, exciting things happening every day. But today we're going to focus on you guys and Modular Capital and how you are approaching this space. So James and Vincent, welcome to the Fundamentals Podcast. It's great to have you guys on.
Great to be here. Thanks for having us.
Now, before we start diving into Modular and how you approach this space and what you find most exciting right now, it would be great if you can both give quick introductions on just your backgrounds and how you got to where you are now.
Yeah, happy to. Was born and raised around Silicon Valley. Grew up in the Bay Area all my life. Parents were immigrants from Taiwan. Was always super close to and fascinated by technology. Growing up, just being around the Bay, learned to program and code back in middle school. Had a few engineering internships here and there. But I think in college, really fell in love with investing and specifically this intersection of investing in kind of technology, which kind of shaped a lot of how we grew up, like Instagram, Snapchat. These things took off when we were in high school and college. Uber became this huge phenomenon when we were in college as well. And I think that changed a lot of lives for how people experienced it. I started off my career at D. Shaw out of college. D. Shaw, large, kind of big multi-strategy hedge fund. They manage tens of billions of dollars. I was part of the public markets team there on the tech side. So covered everything from fintech, payments, kind of tech and internet businesses, some software businesses. Cut my teeth there for 4 years coming out of school. Eventually wanted to move over to kind of private venture markets just because you get to work a lot more closely with companies in their life cycle as they're kind of growing and building the business. So moved back to the Bay Area, spent around 2 years at this 10 billion crossover fund called Modular Capital, where I was primarily focused on fintech and crypto investments over there, particularly on the infrastructure side. So as a firm, I'd made investments into companies like Plaid, Checkout, Stripe, Ramp on the fintech side, and then Chainalysis, Fireblocks, FalconX, a lot of these big crypto kind of vendors out there on the crypto side. At some point, I think we were just seeing how fast the crypto industry was evolving in terms of the infrastructure built out, in terms of the applications that were coming out. I think the industry, since we had first looked at it back in 2016, 2017, 18, as like payment analysts, had just matured a ton. And Vincent has been a good and dear friend of mine for over 5 years, and the two of us wanted to go at it together.
Yeah, so I was in traditional finance for the last 10 years. And like James, always fascinated by this intersection between technology and investing. So I started off my career doing tech investment banking at Evercore, and then private equity at Searchlight. But most recently, I spent the last 5 years at Holocene, which is a hedge fund based in New York. And there I invested in structural winners throughout fintech, software, and internet. And me and James actually first met at a fintech idea lunch back when he was at D. Shaw. And given crypto intersected a lot with fintech, we obviously followed the rise of crypto in 2017, the whole ICO mania. There's a lot of promises, but there wasn't a lot of traction. But then again in 2020, but this time was different, right? There was real user adoption. There was fundamental metrics you could actually look at. And coming to the space as a public equity investor, the reason why I was so excited is you had this emerging asset class with really strong technology tailwinds, with really inefficient markets where people were still figuring out their investment frameworks and how to invest, especially on the liquid side. And in traditional finance, you had hundreds of buy-side analysts and dozens of sell-side analysts from every single bank covering every stock. And this lack of traditional institutional coverage was particularly compelling to me as well.
Yeah, I love that. I think both your backgrounds sound, they fit pretty well together. Now you've kind of merged to make up Modular Capital. So moving on to that, can you give the origin story there and maybe just the high level specs of the fund as well?
Yeah, definitely. So I think as we were following just crypto over the course of 2020, 2021, I think something that stood out to us, especially coming from kind of traditional kind of public-private tech investing backgrounds, was just this development value accrual for a lot of tokens in the ecosystem. I think historically, if you looked at most of the tokens since Bitcoin and after, a lot of people thought about these as currencies, pseudo commodities. People would build supply demand models to how to value them. Those are all structurally very different frameworks in how you would think about traditional businesses. And you had a lot of examples from this. I think something like Ethereum, as it went through the EIP 1559 upgrade in 2021, that structurally started to burn a large portion of the transaction fee as opposed to giving it back to miners. And that created this kind of very large structural value accrual for ETH as the token. And you could actually kind of apply some of these fundamental frameworks to thinking about, okay, what can ETH be worth as an asset? I think that's certainly true for a lot of DeFi tokens that folks would look at, whether it's Uniswap, if they were to turn on a fee switch, whether it's products like dYdX that charge 2 to 3 bips for trading derivatives on their platform. And then there's this explosion of vendors like Dune and Token Terminal that kind of allowed people to kind of understand and sift through some of that. So that to us felt like this incredible opportunity just in terms of crypto slowly molding more and more into an asset class that has fundamentals, that is driven by fundamentals, and this opportunity to come in and kind of overlay a lot of what we've done for kind of traditional public and private markets into this kind of incredibly exciting and emergent and evolving asset class. So Vincent and I, we both left our jobs early March 2022. We spent 4 months putting the fund together, kicked off our launch with around 20 mil of capital. The fund is set up. We're long biased on the liquid side, which is the majority of our portfolio. We look to identify and find around 15 to 20 investments. We're not traders by background. We're underwriting these and going through all the type of diligence work that you would traditionally want to do for a public investment in Apple or Facebook or DoorDash or any other tech company. So we're thinking about business, the structural tailwinds, the market opportunity, the competitive landscape, market structure, how do you monetize, all those things, as well as getting to know the team, which is a pretty big part, just given how early these protocols are in their life cycle. We have up to 30% of the fund that can opportunistically invest in venture. And for us, that's a good way of identifying certain things that are just kind of not publicly listed yet or in the token markets for us to also build into the portfolio.
Yeah, that's awesome. Thank you for that comprehensive overview there. Now, we as investors, we're pretty used to pushing the project we invest in on product market fit. In these sessions, I actually kind of like to flip the script and push for understanding the product market fit of funds in the space. So starting there, the first question would be that as you're running Modular Capital and you set that up and got the first 20 mil committed, what was the core problem that you solved for LPs to get that capital in?
Yeah, if you think about where we are in the market evolution for crypto, I think we're in a very unique moment, right? If you think about crypto over the last 5 years, venture made a lot of sense as there were a lot of these 0 to 1 build outs, especially on the infrastructure side. If you think about where we are today, you still have the ability to generate venture like returns, but in the liquid markets, and you finally have enough asset selection to construct the liquid portfolio. And functionally, you're investing in Series A to C companies, which still have 10 to 50x growth potential. On top of this, protocols have already shipped their products for the most part, so you've de-risked execution somewhat. You also have the opportunity to monitor fundamentals and traction in real time, as well as liquidity to scale your position as you see your thesis play out. And as I talked about earlier, there's still a lot of really inefficient dynamics when it comes to the liquid markets due to the fact that there's not a lot of traditional institutional coverage. So we think that this is the largest opportunity today, especially on the lower market cap protocols where we spend a lot of our time.
Yeah, definitely. And I mean, you covered a lot of the great points there on what makes crypto interesting from an investor's point of view. And to kind of dig even deeper into that, what would you say, like, when you look into the space, what are the top things that excite you about this asset class as an investor?
I think when we take a step back, there's a few very unique things that blockchains specifically solve for that I think are kind of new paradigms or new step forwards. I think the first is this removal of trusted middlemen in the equation. I think historically, if you look at financial services, if you want to send a wire payment internationally, a lot of times what might happen is it might have to jump through kind of anywhere from 3 to 10 different payment hubs. And then each of those middlemen in the process are taking a cut with a fee. And that's because these banks don't all sit on some same ledger where they can kind of directly communicate with each other. If you look at something like global payments, people pay anywhere from 1% to 3% for card payments because you need these middlemen like Visa, MasterCard sitting in the middle to intermediate that. I think with a lot of crypto applications is that you have the underlying application infrastructure that's built. Think about something like Uniswap. But once that is deployed, there really is no middleman and that transaction can happen very seamlessly. So if you try to go swap USDC to Euro stables on Uniswap, that transaction is going to cost you kind of less than 5 or 10 pips because there's no intermediary outside of the software application that sits in the middle. I think the second really unique thing is this composability element that I think is really important and near and dear to the crypto ecosystem. You look at how traditional tech applications are built, they're all siloed from each other by default, whether it's Google or Facebook or Twitter. And it requires that specific application developer to create kind of a set of APIs to expose what they want to expose to the external world. It's a slow process. It hinders innovation. Those developers need to spend a significant amount of time to maintain that interoperability layer. If you think about crypto applications, as long as they all sit on the same ledger or smart contract platform, they're all composable and interoperable by default. You can have a lending protocol like Aave and Compound, where if they need to have liquidations happen, that can be facilitated through Uniswap to go kind of sell certain assets. You can have something like Lido, which creates this liquid staking receipt that you get back. And now that's something that you can put into a lending protocol, right? To kind of both be able to stake your Ethereum, but also continue to have liquidity on your asset. I think you can go on and on with a variety of what these use cases look like, but because you're interoperable by default, you allow the market forces to go be creative and kind of ultimately find its way to applications that make sense. And that massively accelerates the pace of innovation. I think the last thing is crypto solves for this inertia of coordination at scale. And I think you've seen a lot of really interesting use cases of that, where the product's only useful if you get a large enough number of either capital or participants to come together and to all do something together. Historically, these network effects can be very difficult to build, but if crypto acts as a way to structurally accelerate that, that can be something that's entirely kind of digital in the case of DeFi protocols that need to bootstrap liquidity to get started. I think there's a lot of successful cases of that with trading protocols like Uniswap or dYdX, with lending protocols like Aave and Compound, where initially you had some set of incentives to attract sufficient liquidity to the platform. But once you have enough liquidity, you can kickstart the flywheel of kind of users either trading or kind of borrowing assets. You also have physical examples of this. So think about something like Helium, where the network's only useful if you actually have millions of kind of IoT hotspots that are part of the network. Or think about something like what Akash and Render are trying to do with building this decentralized GPU network where people can lease back excess GPU supply that they aren't using. So kind of blockchains act as this kind of mechanism to solve for these types of coordination points that traditionally can be quite difficult to kick off. I think most importantly in all this is that the combination of these not only creates a lot of opportunities for financial applications and use cases that unlocks, whether it's stablecoin payments, whether it's on-chain trading, lending, kind of staking type infrastructure, but you're also seeing these applications permeate to things that are not just strictly financial, right? So when you think about something like what Akash and Render are doing, that is competing or kind of opening up a new market, right? Where you're structurally adding more supply for people that kind of want to train or kind of run model inferences with GPUs. Or you think about something like Helium, that's very orthogonal. That just relates to going after an opportunity that traditional telco providers would go after. And I think that combination of these sets of core primitives, but also being able to tack on industries that are both financial, which is a very large industry in and of itself, but also these non-financial use cases. That was an incredibly appealing opportunity to us.
Yeah, I definitely agree. And the characteristics of this asset class are so lucrative that, especially once you start digging into the details, it's kind of hard to focus on anything else. But still, at the same time, for us, these things might seem obvious, but you notice that from the outside in, if we take a traditional investor's perspective, there's still a lot of confusion. It's a bit hard to grasp how multifunctional these assets actually are and what is going on there. So, as you both have a plethora of experience outside of just crypto as well, what would you say are the biggest misconceptions that investors outside of the space have about this asset class? So what are they not really getting?
Yeah, definitely. We talk to traditional investors still all the time. So I think the three primary misconceptions about crypto right now are: first, people are still very surprised that crypto protocols are real businesses and can generate fees, right? If you think about crypto over the last 10 to 15 years, it's been primarily dominated by Bitcoin, which was this digital gold, this great macro asset. Only really over the last 5 or 7 years have you really seen fundamentals emerge and ways to invest through that. And James talked about this earlier, but we had this page in our deck where we showed Ethereum versus the leading tech stocks, right? And at the peak, Ethereum was 600 billion market cap, generating 20 billion in fees, trading at 30x, returning 15% through dividends, 85% through buybacks. So walking them through this sort of example, as well as protocol specific examples such as Lido or GMX, further highlights the point that these are actually productive assets. And then second, to your point, people still think this is all very conceptual and are often surprised there are real products you can go try out, right? You can go on Audius, which is this live streaming music platform where creators are better able to connect with their fans. It has 10 million users, right? Brave is this privacy preserving browser where the user opts into advertising and earns a revenue share. They have 50 million MAUs. Right? Brain Trust, you can go hire freelancers at a much cheaper cost. They're doing 100 million of GMV. And James talked about Render and Akash trying to build these decentralized GPU marketplaces, which brings me to my last point, right? And James talked about this, right? People think crypto is all circular and isolated. These themes that we're talking about can be so disruptive over the next 5 to 10 years to all these traditional sectors. And I think as more and more institutions wake up to this, they will need to add crypto protocols to their coverage, right? The internet analysts will cover Spotify and Fiverr, but also Audius and Brain Trust as they continue to take share. The semis analysts will cover NVIDIA, but also Render and Akash as they create this on-demand secondary market for NVIDIA chips. Gaming analysts will cover EA and Take-Two, but also Illuvium and Sandbox as they introduce these new innovative ways to monetize gamers. And what's most important is they're going to be using similar investment frameworks that they use in traditional equities to this new asset class, further highlighting the focus on this fundamental analysis that we're talking about.
Definitely, that's a really well put. Now, one big characteristic change in this asset class from a venture fund perspective is the liquidity aspect. In a traditional VC fund, it's a very clear path from pre-seed to seed A, B, C, and keeps going on. The liquidity events are very clear. It's either IPO or an acquisition at some point in the long-term future. Liquidity brings a lot of maybe more optionality to that mix. And how do you think of it from an investor's perspective? Because James, you also mentioned at the beginning there that you have about 30% of the fund reserved for venture, which isn't necessarily then that liquid yet going on. I don't know if you do outside of on-chain investments, so in the more traditional space. But if you're playing around with both, what do you see as the pros and cons of both traditional and liquid venture?
Like you said, our fund does both. I think from our side, so structurally venture and liquid tokens, behaviorally, they seem quite different to investors. From our perspective, we think about it more from where in the life cycle of a protocol are you investing in? And I would say that's the primary lens we think about this through. If you think about early stage venture, you get to be there at the earliest days of a company's founding. It might be just the initial founding team with a couple of people. The valuations are low, but at the same time, there's also significant amounts of risks that you're taking on as an investor. That can include team risk, whether it's the founding team or them having to make a lot of key hires to build the product. A lot of times you might have a prototype of the product hasn't shipped yet. So even though you might have a thesis or a kind of inkling of what the product market fit might be, that's something that still needs to be proven. If the product ships, a lot of times like you're taking on the fact that it hasn't been battle tested yet and there might be contract bugs along the way. But in addition, you're also locked up on your investment for a significant amount of time. If you make an equity investment, the IPO process can take 10 years or longer. And if it's a protocol, usually you're talking about 3 to 5 years of combined kind of lockup to invest in along the way. If you think about the liquid side, functionally, these are really they're still quite early in their life cycle. I think if on the early stage venture side, you're thinking about pre-seed, seed, maybe series A, a lot of our liquid investments in tokens, we really think akin to something like a series B or series C investment into liquid markets. I think that can be in two categories. I think on the more mature side, oftentimes for protocols that are north of $500 million or $1 billion in market cap, they're usually generating some large amount of cash flows. It means we can go on token terminal and find very robust transaction, kind of fee, revenue, unit economic type analysis to dissect the protocol. It usually means there's some kind of very stable amount of product market fit that you expect the protocol to be at. And that could be something like dYdX, where they're the largest decentralized derivatives exchange that people trade on, and they do hundreds of billions in annualized volume. It could be something like Lido, where they have nearly 90% of share in the liquid staking market and roughly around a third of total stake for Ethereum. Or it could be something like Maker, where you have billions of issuance for a stablecoin and you're generating kind of 9 figures of revenue. By then, you're usually thinking about the business on some multiple of cash flow. It could be 20 times, 30 times, 60 times, but there's some sort of mature fee metric that you really start to begin thinking about. There's also liquid token investments that are earlier in their life cycle. So they're a little bit past where you are on the venture side in the sense that the product has shipped. There's some dashboard you can go on to track some North Star KPI, whether it's a volume-based metric or whether it's kind of user metrics or whether it's a fee metric. The product has shipped. It's been out on mainnet for some time. You can go play around with it. You have some semblance of how much product market fit it's garnered. But it's still quite early in the sense that you're not thinking about it on some fee multiple, right? So usually they're in this 50 to a couple $100 million market cap range. They're not as mature as something like a Lido or dYdX is in terms of its growth evolution. But at the same time, like it's way past where a venture investment might be. When we think about it from the fund perspective, we have investments in all of these. Like we've invested in early stage venture investments that are anywhere from 10 to 30 mil in valuation. We're investing at a period where the team is less than 5 people and the product is still 6-12 months away from shipping. We have a ton of liquid investments in this 50 to a couple $100 million market cap range, where functionally we're happy to go in and buy 0.5%, a couple percentage of the total supply. And we treat it as basically a venture investment in the fund in terms of what we're underwriting it. And then we also have these larger, more established protocols like a dYdX, like a Lido that will hold in the portfolio, which we think can still continue to have significant growth runway. Let's call it like a Series C equivalent investment in the crypto space. So we'll have investments in all of those based on what the risk reward looks like, based off of structural market themes that we're excited about. But that's the way I would describe kind of how we think about this different kind of evolution and life cycle of where you are as a protocol.
Does the liquid venture aspect bring kind of more work internally for the fund? Because if we think of a traditional fund, you'd ideally have like an exit strategy on paper, right? But then again, the actual exit opportunities, they kind of come to you and then you consider case by case on whether this fits. But when you're liquid, you can basically exit a position whenever. So how do you think about the exit strategy in those? So what do your like investment periods look like on the liquid investments?
So when we underwrite an investment, our default is we're underwriting over a period of 2 to 3 years. I think anything longer than that in crypto is too far for people to actually have a realistic forecast on. And anything shorter than that, I think a lot of times is subject to just like natural market gyrations, natural noise that doesn't actually reflect in the fundamentals of a project or just the price movements that you see day to day. I would say the main thing on the liquid side that's very important to us is this ability to real-time monitor what's going on in the market and to what extent is our thesis being validated or invalidated, and because you have the structural liquidity element. So while you enter an investment with the intent of being a multi-year investor, the reality is we have a responsibility to our limited partners to monitor our portfolio on a real-time basis. Typically, we'll have models that we're updating on a monthly basis for every investment category. We're very disciplined around understanding who are all the key players, what does the competitive landscape look like, are there new entrants, how is relative share evolving, are there kind of new key structural advances that are going to structurally change what the competitive landscape might look like or the ease of entrance to come in. So those are all things that are really important to us. Just to give some examples, if you think about the perpetual DEX space, you've had some large players that have been established. They all have dashboards and token terminal. They include synthetics, dYdX, GMX. But there's a huge amount of new competitors that are coming out into this market. There's structural differences in what the kind of models these all have built for trading, whether it's an order book model or kind of a trade against a pool type model. So those are all things that we'll go and understand. We'll try to understand kind of what the market share dynamics look like. What are the things happening? Is there someone that's kind of changing one component of how their application works that might influence share for other providers? If you think about something like liquid staking, I would say a key event was, hey, when Ethereum finally allowed you to unstake, right? That was a key defining moment for how does it start to impact share for a leading protocol like Lido, where historically your moat has been, hey, people want to exit and you have the most liquidity. So something like that we'll track very closely. And what you've tended to see in that market is that Lido has not only been able to reduce the amount of incentives that they need to provide, but they've actually continued to gain the most share with the least amount of incentives. But I think that's an emerging behavior that you've seen that's very powerful. And then finally, you might have something like the bridge space where there's 5 to 10 key players. You're starting to have protocols or providers like Circle offer some native bridging experience that tends to be lower in fees, but has a significant longer amount of transaction processing time compared to bridge providers, right? All of these types of things we'll monitor fairly in real time. Day to day, we're not trading our positions. When you underwrite them, we're looking several years out because we think crypto is a long duration asset in terms of kind of what these types of applications can do and grow into over the course of time. So we always want to have that long-term horizon, but that doesn't mean we shy away from kind of understanding the ins and outs of kind of what's happening pretty real time, especially around some of these very important events and competitive changes.
Got that. And thank you for sharing those examples as well. I think it helps listeners put your thinking into context as well around what events you actually do actively think about these things. That's great. Now, Vincent, earlier on, you mentioned that one big misconception traditional investors have that they don't quite get the fundamentals yet of this space, or that there are actual cash flow generating businesses, etc. Now, as a fund that is fundamental and thesis driven, could you help everyone out a little bit and dive into what fundamentals of crypto projects actually mean from your perspective and how you're applying that thinking to the space?
Yeah. So it's really no different than how we evaluate traditional businesses, right? In the long run, we look for the profit potential, right? Some user needs to be willing to pay for some service. The protocol will have expenses, whether that's oracles, fees to liquidity providers, and then generate a profit margin on top of that, right? And we segment the universe into 2 buckets, right? On the one hand, you have these larger, more mature market cap protocols, which have durable cash flows today that you can underwrite against, right? James talked about a few of these, right? Lido, the largest liquid staking protocol with 30% share, does 30 to 40 million of revenue. dYdX, the largest perp DEX, which does 300 billion of volumes, does 50 to 100 million of revenue, right? Both of these trade at a 2 billion market cap. And on the other hand, earlier in the life cycle, we're less focused on the cash flows generated, but rather the end markets and the industry specific KPIs that demonstrate product market fit. And that could be anything from number of users, GMV, the number of NFTs being minted, the number of GPUs on testnet, right? And what we're thinking about is the protocol's potential over the next 2 to 3 years. And monetization in this case matters a lot less to us, right? It's no different than early days Facebook, which focused on users and didn't turn on monetization, or ETH early days when there was little to no fee support.
Got that. Thank you. Now, if we move on to speak a bit about your underwriting process, now that we know how you're approaching this space at a high level and you're thinking there, how do you source deals, dive in to do due diligence, and then finally make decisions on what you actually want to invest in?
First and foremost, we're very thesis-driven in our approach. We believe crypto is extremely early in its life cycle. And the way we've constructed the funds lends to that, right? Fairly concentrated, 20 positions, long only. We're not traders by background. So that allows us to focus on the protocols and sectors where we believe there are still 10 to 20, even 100x outcomes backed by these really powerful structural tailwinds. In terms of due diligence, it's very similar to what we did in our prior jobs. Look at things like total addressable market structure, competitive landscape, monetization potential. And obviously, given these are all very early stage companies, the most important thing is to have high quality and trusted teams building. In terms of idea generation on the liquid side, we have a coverage-based model where we focus on all these different sectors we're very excited about, whether that's real-world assets, perp dexes, staking, NFT infrastructure. And to James's point, the space changes so quickly. So having a deep grasp of each sector and all the different protocols, we think generate very unique insight. So that means monitoring all the industry metrics, market share, competition in real time, talking to the teams, and understanding how some of these events and changes impact the sector. On top of all of this, data plays a very key role. So we've built automated dashboards that help us understand size of market, relative share, monetization. And if I think back to my old job in TradFi, it really is a public investor's dream, right? Hedge funds would look at weekly credit card data or website visits or app downloads to try to gain a sense of how a company was doing intra-quarter and also try to do deeper analysis that you couldn't do with publicly reported numbers. Here, given all the data is publicly available for all companies, you can not only monitor things in real time, but you can also do all sorts of really interesting analysis to further build conviction in your thesis. In terms of decision-making, basically me and James both need to agree on something to put it in the portfolio.
Yes, thank you for sharing that process. That was really clear. Now, diving maybe a bit deeper into the data aspect of that, because of course, that's what I love to talk about. And the beauty of crypto is the data is there, and we do our best, of course, to make it easily available. But with these dashboards and what you have, at a more detailed level, what data do you look at? How important a part of your process is it?
So the data is super important to our process, especially on the liquid side, because by the time a product has shipped, ultimately the true judge of how well the protocol is doing is the behavior of the users, is the level of activity that you're actually seeing. The specific type of metric that matters is really going to depend on both the sector that you're looking at and the specific category, as well as the maturity of the protocol that you're investing behind. So I can give a few examples. I think if you look at something like the decentralized, like perpetual derivatives trading space, there's a few key metrics that we're most focused on. At a high level, you're looking at volume. Like that's a very standard metric that you think about for any trading application or business. But the fees really matter, even though the take rates may differ between these exchanges. But we'll also want to dig in and peel a few layers behind. So we really care about the number of users that are on the application. A lot of times you might see an emergent protocol that is showing a lot of volume, but then you actually dig in on the number of daily active traders and it's something like 20 or 30 people. And situations like that are significantly more likely to just be fake volumes or the team themselves trading the protocol to generate activity. We care a lot about the emissions that are coming out to drive that sort of trading activity. That can either be on the liquidity provider side, which a lot of these protocols have done. And I think it's a pretty healthy way to bootstrap initial use of a trading protocol because you need enough liquidity for people to take large trade positions against. But some of these protocols will have pretty aggressive trading incentives out of the gate. And it's important for us to peel that behind and understand, hey, if they're doing $100 of volume, what percentage of that volume is actually real? If you were to take away the incentives, which do tend to happen over time, how much of that volume is actually going to remain? So that's an example of how we might peel back the analysis for that space. If you think about, there may be other spaces where you don't have that level of complexity. Our fund has a position in Metaplex. We're really excited about what they've done on Solana, and I think 99.9% of NFT mints on Solana are done through the Metaplex standard, but they've worked to ship this new compressed NFT standard that is really exciting in terms of what it unlocks. The price to mint 1 million NFTs through this compressed standard is now only $100. And that's kind of orders of magnitude improvement versus what you used to do on Solana, but certainly even more orders of magnitude cheaper compared to doing that on Ethereum. For something like that, today, they're not monetizing that product. Today, we primarily care more about the number of mints that are happening. What's the chance that they will continue to dominate as the standard in the Solana ecosystem? What are the types of applications people are finding and using with compressed NFTs? So that sort of analysis then starts to look very different, right? Those dashboards that we're looking at will be more around the total number of mints across uncompressed and compressed NFTs. It might show you kind of the mix of, hey, out of all the NFTs that are minted, how much is being used for one application versus another, and what's the diversity of use cases that we're seeing. So that will have less to do with fees, and that is an example where you don't have as much direct competition today. So the flavor can really change. At the end of the day, like every space is going to look a little bit different in terms of how we're going to dissect the data. There's no kind of cookie cutter, kind of very template solution per se for how you overlay data onto our analysis. But data is this incredibly important toolkit because at the end of the day, in the liquid markets, you have to be data driven with how you're choosing to invest and allocate our portfolio. And ultimately, while we care a lot about just the general activity, the kind of structural tailwinds, some of these kind of use cases that people are excited about, at the end of the day, we do need to see this translate into positive kind of behavior or traction or activity from a data level.
I think that's an incredibly important point, and one that can't be emphasized enough is that like any single data point can't be like trusted on its own without putting it into context and also peeling back on what's happening in addition to that. Because I remember when I first got into this space, I made some, looking back at them, absolutely horrible data-driven, or what I thought was data-driven investments based on like purely fees generated without looking at all at the actual incentivization and token inflation activity happening behind it. But I'll just say I've learned quite a lot over the past 3 years, but your point can't be emphasized enough on that one. Now, with that process, would you be able to walk me through any of your investments and the thesis behind what made you pull the trigger on them? That would be great to kind of get like a case walkthrough.
So maybe I can do one, and then Vincent can pick one from our portfolio and do one as well. I've mentioned dYdX a few times, so it's no surprise that it's a protocol that we spent a lot of time on. It's a fairly large investment for us at the portfolio level. I think I can go through kind of the three prongs of what the general market opportunity is, why we're specifically excited about kind of the architecture that dYdX has, and then some kind of more specific kind of catalyst kind of related things from kind of why we're excited about it from here. I think from a market landscape, trading is just one of the largest activities in crypto and one of the most lucrative. It's the reason Coinbase is kind of a $20 billion market cap company. It's the reason Binance is kind of one of the largest businesses created in the crypto space. And if you look at the market landscape today, the vast majority of the volume for derivatives trading goes through centralized exchanges. I think today, these exchanges, if you add them all up, they're doing on the order of 30, 40 trillion of annualized volume. I think at the market peak, that was north of 100 trillion annualized. And the percentage of that's happening on chain is just 1 or 2% today. There's a lot of reasons for that. It takes time for liquidity to migrate on chain. The on-chain trading infrastructure historically hasn't been able to handle the load. The number of trading pairs available is just kind of not sufficient. But also historically, like the kind of the wallet setup, wallet infrastructure, kind of managing kind of self-custody, those have all been friction points. And I think as you move into a world where the trading infrastructure scales, where people get more comfortable and sophisticated, and kind of the UX around self-custody improves, and I think that's a huge secular tailwind that we're generally quite excited about. Then you can decompose that into, okay, what are all the different models to do this in the market? And there's a lot of these. If you look at some of the first instantiations, People tried doing it through a virtual AM model that has all sorts of drawbacks and is highly inefficient. People tried doing it with these pool trading models that you see with GMX and synthetics, which have been incredibly successful, but that's architected for an EVM chain where you have significant limitations for the amount of throughput you can run over, even if you're on a roll up like Arbitrum. I think structurally, long-term, the order book approach is going to be the one that attracts the most volume. You can go look at traditional markets. It's just very clear, like order books have always been the most efficient way to match bids and sells, and it offers users the tightest pricing. So dYdX, I think, has architected themselves around what we think is kind of the best long-term model. If you look at them, they've also evolved the application significantly. The current dYdX product that's out on the market, even though the user funds are self-custodied by the users, but they haven't had the ability for the order book to be decentralized. So dYdX themselves actually fully runs the order book, which means dYdX were no longer able to operate it, then the exchange just functionally shuts down. So they spent kind of over a year, probably close to 2 at this point, going through this product upgrade and migration. It's currently in testnet. They'll launch on mainnet over the coming months. But they've taken the Cosmos SDK, built their own custom chain, and the future version of the product will have every component of the application fully decentralized. And whether that's the order book, the matching engine, the validator set, even the website front end, the user funds will be kind of fully custodied by the users. But they've also done a lot to kind of ease the user migration along the way. There's native USDC support on Cosmos. Users are able to use MetaMask, which is the most widely adopted wallet, in order to continue to transact as opposed to have to migrate to a new wallet. We think structurally, this is a trend that we're incredibly excited to kind of be behind over the course of the coming years. We want to bet on this incredible team that has already built the largest derivatives exchange in the space, but is going to continue to upgrade and refresh the product so that it can continuously address more and more of this market opportunity over there.
Yeah, I'm pretty excited about what's going on at dYdX. I think it's the crazy, like the app chainification as well of a lot of these leading protocols is something that I'm following pretty keenly to see how that develops.
Definitely. And there's a huge amount of data that has gone in to inform the decision. So one of the most positive developments over the course of this year is dYdX used to be incredibly incentivized on the liquidity side, on the trading reward side. And the reality is when you're bootstrapping this order book, it's just a very non-trivial thing to do, right? Because you need this two-sided liquidity. So the token historically has been used to give out a lot of incentives to do this. But what you've seen over the course of the last year is that they've cut the trading reward super aggressively, where for the first time, you have the total amount of revenue they generate from their current protocol outpace the trading rewards given back. And that is a pretty consistent pattern that you've seen month over month. And then they've also started to just recently cut over the last month, the rewards start given out on the liquidity side, where historically they were just given outright in the form of tokens. Now they're giving a rebate back from the fees they're charging. So those rebates to market makers are only given out if there actually is positive revenue that's generated. It's one of these investments where there's a lot of things that line up. You have secular tailwinds behind you. You have a huge protocol upgrade in terms of an architecture that will be more long-term sustainable. You're seeing kind of incredibly positive data from a market share perspective, from a unit economic perspective, as they pared back a lot of these incentives that have historically been given out. And at 2 billion, I think this is a protocol and category that can lend itself to creating market caps in the orders of tens of billions.
Definitely. How about Vincent? Did you have something from the portfolio that you could walk through?
Yeah. So on the small cap side, we like Across at 50 million market cap. So Across is a bridging protocol that does about 2 billion of volumes annualized. And if you assume they can eventually get a 5 bips net take rate, that's about $1 million in fees. So effectively a 50 times multiple. So we're very excited about layer 2s as a category. We think this is how Ethereum will scale. You have Arbitrum and Optimism, which flipped ETH in the number of transactions. You have the ZK layer 2s starting to gain traction as well. You're starting to see the rise of all these specialized layer 2s, whether it's Avo for options trading, Kinto for permissioned RWA, and Base, as you guys were talking about earlier, are going to bring on all these new Coinbase users. So to tie all this together, we think bridges will play a very important role and be a key pillar for infrastructure. So when we step back and look at the bridge market today, bridge volumes are about $100 billion, which is about 10% of spot DEX volumes. As layer 2s generate more and more activity, especially post EIP 4884, we think transaction costs go down by a factor of 10. and this activity will surge. And this percentage against spot DEXs should increase significantly. And then when you think about market share on a headline basis, across only has low single digit share of bridge volumes, but there's a lot of airdrop farming going on for layer zero. So when you normalize that out, across has closer to mid-teens, 20% share. And what makes Across very unique and different from the other bridges is that while the other bridges use provisioned liquidity in each location, Across has a single liquidity pool with relayers who compete to provide the best price and execution. So this has led Across to be the most competitive from both a speed and cost perspective versus the competition by a factor of 50 to 80% in some of the major bridging routes. And when you look at the aggregator data, which optimizes speed and pricing and strips out airdrop farming, Across actually has closer to 30 to 40% share. And given the ease of use and the user experience, we think aggregators will continue to take more and more share, which should significantly benefit Across. So to throw some high level numbers out there, but bridge volumes go to 50% of DEX volumes and Across gets a mid-teens share. Across will be doing, call it $50 billion of volumes, right? And if you can get a 5 bips net take on that, that's 20 million of net revenue. If you put a 20 to 30 times multiple, that's a $500 million protocol. So obviously the risks are Stargate has done a really good job and can continue to gain mindshare even post airdrop. The CTP from Circle risk and bridges historically have been prime targets for hacks. But at 50 million valuation, you have a really great team building against this important and growing TAM. We think it's a pretty attractive risk reward today.
I'm glad you shared that. I actually had a discussion with Art, one of the co-founders, early this year. And I have to say that I'm also a fan of their approach and how they've positioned themselves in the market. So what their USP is. So definitely, I just remembered I probably have to ask them on again to get the latest updates. What's happened over the past 7 months.
Yeah. And the key data-driven insight is really when you look at the aggregators Across having this 30-40% share, and aggregators optimize for the speed and pricing, and the lowest cost, best product sort of wins when it comes to aggregators. So I think that really shows how much traction Across really has gotten versus if you look at just the headline numbers, low single digit is not a lot.
Got it. Thank you both for sharing those. That's super fascinating. Now, as you invest across a variety of stages from very early to a bit later on in liquid markets, how do you generally work with the projects you invest in?
I think the day-to-day operations of the business and kind of just the kind of routine ins and outs, those are all things that we need to underwrite the team to be incredibly high quality, incredibly high caliber to execute against, right? We will never know the kind of ins and outs of the technical architecture, the code that they're shipping, the competitive landscape. That is something the team will live and breathe. And for us, it's incredibly important that kind of we think it's the right team to go after the opportunity. I would say where we love to come in and plug in is really anything around the edges that can just help the team out in ways and just improve their odds of success. I think there's a few examples of that. We've had kind of early stage private investments where the tokenomics are still getting fleshed out by the team. And we've been on several calls with them to kind of dive in, kind of help them think about what's the right tokenomic structure to have. How do you think about the split of fees to all these different constituents that you're trying to make happy? Are there ways to kind of use the token early on to bootstrap a certain amount of liquidity or activity onto your network? And just what are some other kind of common examples that we've seen from successful protocols that we tend to observe in markets? A lot of times, there's introductions that we make that can be quite helpful. It could be on the vendor side in the case of banking partners that folks are looking for. We've facilitated introductions for portfolio companies for kind of press release on their launch day. We've, to the extent they're putting together a next raise or round, we have a pretty deep network with investors to not only help the team with polishing and kind of giving feedback on their deck in a way that we think kind of will help them showcase what are the most exciting things that are going on, but also making intros to the right investors who can come on and be pretty value-add partners in addition to us. So we're a pretty lean team. I think we're happy to plug in whichever way that's helpful to protocols. We want to be helpful partners with them in ways that we can. The day-to-day operation of the protocol, we kind of trust the team to execute well and deliver.
Yeah, that makes sense. Now, if we look at the space as a whole, what trends or market sectors would you say currently stand out or alternatively aren't getting the attention that they might deserve?
There's a lot of really hot trends in crypto. There's hundreds of perpetual DEXs that are being launched left and right. That is a space that's fiercely competitive. this whole liquid staking finance space is like super hot. I think we probably want to touch on two that we think are going to be super important over the coming years, but that I think is not kind of thought about in that sort of mainstream way yet. I think one is just this tokenization of traditional assets and bringing them on chain. And I think the first instantiation that you're seeing this happen in a really big way is with this tokenized treasury bill asset class that has really taken off in crypto. I think for a long time, you had crypto yields that were super high, TradFi yields that were super low. I think now that is inverted to a large extent. So you have a lot of this latent USDC, Tether, other sort of stables that want to be able to access. So this type of yield, keep their assets on chain and earn a healthy kind of 4 or 5% yield. I think if you look at the dashboard that RWAXYZ has on this space, the amount of tokenized treasury bills started this year, 200 million. I think it's getting close to 700 million now. They'll probably exit the year north of $1 billion. And I think as we go into next year, this will probably be like a several $billion asset class. It's important for two reasons. One is it's not an easy effort to do because of existing kind of regulatory structures. So there's been a lot of different approaches that teams have taken to try to solve for, hey, how do we do this in a compliant way to bring these assets on chain? A lot of times you need KYC infrastructure so that this is only given to accredited investors. The rules can differ between whether those investors are in the US or not in the US. There's a variety of approaches to tackle this, whether it's kind of issuing the ETF, you're like being the issuer of the ETF yourself, and then also issuing that as a token on chain. There's ways where people will bring in entities so that there's a kind of borrow lend structure involved in the middle to facilitate this. Some people will, instead of buying the treasury bills direct, they'll go and tokenize the bond. So I think there's a huge amount of just regulatory operational complexity that is being solved, that is being iterated on. But this as a first step in that direction allows that to be kind of worked through eventually so that you can bring a huge amount of other types of traditional assets on chain. I think the second is people are seeing for the first time, what is the benefit of having traditional assets on chain? Because that's a question that I think a lot of people kind of may not fully understand. And there's a lot of benefits with that. I think one is historically, if you have a treasury bill on your Fidelity account, that's not an asset you can move around and be composable, right? You can't just say, hey, I want a loan against this asset. You need a specific bank that like allows you to do that. You do not have 24/7 liquidity on that asset. If you want to get out at 8 p.m. on a Tuesday to do something, good luck. Like you're not getting that capital out of Fidelity. As you bring these assets on chain, those are things that you structurally unlock. If you have a kind of tokenized treasury bill and you want to go borrow against that in some permissionless kind of lending application, that's something that you can go and try to do. And you as the owner can solely decide that as long as there's an application. If you want to get liquidity on your treasury bill at 8 p.m. on Tuesday to go do something with that capital, that's something that you can do because it's on chain and you can build a set of infrastructure where liquidity is provided during off hours. And then kind of whoever takes the other side of the trade can go redeem that on Wednesday morning. So there's a litany of these benefits that kind of start to get unlocked because everything's on a single ledger. Everything happens instantaneously. Kind of you benefit from the composability of these types of applications kind of built around these on-chain assets. So I think that's a very powerful trend that we're excited about over the next couple of years. I think the second thing, and we alluded to this earlier, kind of we have a fund position in Metaplex. We think they've done some incredible things on this Solana ecosystem around this compressed NFT standard that I think they've really changed the game for how people think about what NFTs mean and represent and can be used for. I think if you think about this initial iteration that we saw, kind of 2020 to 2022, when NFTs took off as an asset class, it was really linked to this highly speculative kind of profile picture related type use case. And that can be its own use case, right? People can kind of pay for these effective memberships into part of this community. But that's not a really mainstream use case when you think about what NFTs are going to be used for. The reality is having to pay kind of $10,000, $50,000 for an NFT, that's not a mainstream consumer use case that's going to resonate and help adoption with hundreds of millions or billions of people. I think what Metaplex has done with compressed NFTs and bring the cost for minting millions of these down to just a couple $100 has really unlocked a lot of really creative use cases in that ecosystem. You have applications like Drip House, where you can kind of help artists with discovery for their artwork. And you can create a lot of these and kind of airdrop it to a lot of people to kind of help surface what certain artists are doing. You have TipLink, which is a payments application that's built on Solana, where people can go claim an AI generated compressed NFT. It costs the company next to nothing. And it acts as a very efficient way for users to go discover the application and try it for the first time. So you have it used as customer acquisition for a payments application. Helium, they used to be on their own blockchain or their IoT network. They made a migration over to Solana, and to represent each user's hotspot as they were migrating over, they issued this NFT to just represent that. And that's kind of a very unique use case you've seen. And then you have something like dYdX, which is a messaging application in the Solana ecosystem, where the stickers that users can create are all tokenized into these NFT standards. And now you can own them, you can collect them, you can trade them. So I think this is just the tip of the iceberg in terms of what you're seeing unlocked. The reality is people have never been able to kind of predict what technology trends will exactly look like when you look out 5-10 years. I think if you told people where we got to the crypto ecosystem 10 years ago in 2013, I don't think how far we've gotten is anything that people would have predicted precisely. But I think the reality is when you bring down the cost by orders of magnitude, you unleash just the market forces and market creativity to see what can you do with this very unique primitive. And I think you're just starting to see that happen with compressed NFTs. I think compressed NFTs as a standard is going to be a pretty critical part of mainstream consumer applications that we eventually see that reach tens of millions, hundreds of millions of users. So we're super excited to see kind of what happens there over the years.
Yeah, definitely interesting stuff worth following. And then just finally, what would you say are the biggest challenges that you face as a fund in this space?
I think there's two things that really stand out to us when we think about investing in this asset class. I think one is just the amount of noise and volatility in the crypto space compared to what you would traditionally see in kind of traditional markets. I think that creates its own set of complexity for how you need to manage a portfolio and manage your investments. I think crypto every day, every week, there's some new market headline. There's a new thing that people are really excited or really worried about. You have a ton of very volatile price movements that's based on flows, based on forced selling, based on investor unlocks, team unlocks, general sentiment. If you zoom out on the horizon of several years, the reality is most of these near-term price movements have nothing to do with the long-term fundamentals, the long-term trajectory of the projects, assuming that kind of you understand the ins and outs of the mechanics very well, right? And there's no kind of one singular market force that kind of changes or disrupts your thesis. But I think that sort of near-term volatility on obviously like it happens on a daily, weekly basis, but even monthly and quarterly, like sometimes you might go for stretches for months or quarters where the market is not moving in your direction, but nothing structurally has changed your thesis, right? Like the underlying data can look incredible. I think psychologically, that is a very new thing for a lot of investors in this space to manage. But at the same time, I think it looks like a very big structural opportunity to us because a lot of times you can find these dislocations in the market where the data is going one way, the price is going the other way. And it is an incredibly compelling setup to choose to size up your position then and generate outsized returns. But you have to be able to withstand that sort of market volatility that can be ongoing for quite some time. I think the second thing is this data component that we talked about. The reality is crypto is one of the most incredibly data-rich sectors that you've ever seen, right? Because a ton of this data is on chain, it's getting published all the time. Everything is super real time. You're going to have like second by second, minute by minute data, right? On protocols if you choose to have it. But there's a tremendous amount of work that I think is needed to make all this data digestible, interpretable, but also to aggregate it and showcase it in the right way. I think the tooling in this space compared to where it was 2-3 years ago when we first started, kind of looking at a lot of these kind of liquid tokens, I think it has matured quite a bit already. There's a lot of these providers that have provided really rich data for investors to dig behind. But at the same time, we've also made our own investments. We have a developer in our team who kind of puts together all this data. We have custom cuts that we look at. There's a lot of times you may not have data supported by all on one platform, or kind of there's data that's not integrated or ingested into some of these platforms yet because there's so many protocols out there. So all that deepens our ability to analyze, understand, kind of interpret what's going on in the market landscape. But I would say that's a pretty non-trivial effort compared to traditional markets where people take off the shelf information from Bloomberg, from FactSet, from credit card providers, and all this is kind of pretty much served to you on a silver platter. In crypto, this is unstructured, it's non-standardized, it's disparate. There's multiple chains and ecosystems, and that's left to you as an investor to make an investment in that to generate the insights that are very much.
Oh, yes. And I'm glad to be able to say that we have some pretty exciting updates coming to the terminal actually within the next few weeks to make navigating all of this data so much easier, and also speeding up the listing process on our end, which will remove a lot of the problems that come with data being fragmented across platforms. So can't wait for you to get to try it out.
Can't wait for it. We can't wait for it. I assure you it's going to save us a lot of time.
That I can definitely promise. But yeah, that's all I have for today. So thank you guys so much for taking the time to do this and letting us peek into your minds as investors in this space. Really appreciate your time, and let's do it again sometime.
Absolutely. Thanks for having us.
Thanks so much.